You answered 8 questions, clicked Start Investing, felt smart. Somewhere an algorithm is managing your money. It rebalances, it optimizes, it tax loss harvests, and it's probably achieving nothing. The names are everywhere. Betterment, Wealthfront, Acorns, Robinhood. The pitch is perfect. AI-powered, personalized, and hands-free. They claim to be a hedge fund in your pocket for just $3 a month. Today, these robo-advisors manage over $1.5 trillion globally. The same Nvidia and Tesla shares everyone is chasing, they're already in your robo-advisor portfolio, managed by the same algorithm for everyone. But what is that algorithm actually doing behind that clean interface? Here is the reality. The algorithm behind every major robo-advisor isn't cutting-edge AI. It's modern portfolio theory, a framework published in 1952 by Harry Markowitz. He won a Nobel Prize for it over 30 years ago.
Maybe the only one here that wasn't at UCSD when they did, when I made my discovery. The reason is, let's see, if this thing does, this is the 50th anniversary of UCSD and the 60th anniversary of portfolio theory.
Here's what the algorithm actually does. Step 1. You answer a risk questionnaire, 10 questions. Step 2. Your answers produce a risk score. Step 3. That score maps to a preset basket of ETFs, the same basket for everyone with your score. Step 4. The software checks whether your mix has drifted by more than a set threshold. Step 5. If it has, it rebalances. If it hasn't, it does nothing. That is it, a lookup table with a rebalancing trigger, not AI. A spreadsheet with a nice interface. The real AI in finance, the kind used by firms like Renaissance Technologies, is winning in the markets. But that AI isn't on your phone. Betterment didn't invent this. They just made it tap-friendly. 0.25% per year. It sounds like nothing. It is not nothing. Let's run the math. If you invest $10,000 for 30 years, a zero-fee index fund grows to $76,000. But with a robo-advisor fee, you end up with $70,000. You just paid $6,000 for a spreadsheet you could have built yourself. On $100,000, the gap is $67,000, enough to buy a car, or fund the first year of your retirement. Gone in fees. On a $500,000 portfolio, that gap becomes $300,000. The app is free to download, but it charges you for the rest of your life. You're probably paying to underperform. Over 10 years, 80% of active managers lose to a simple index fund. Wealthfront's own data shows a risk level 8 portfolio returned about 7.1%. A simple, free index fund over that same period, 7.8. That gap, 0.7% is $700 every year on a $100,000 portfolio, compounding forever. Taken from you by an app that is supposed to be on your side. And that 2% tax loss harvesting benefit they claim? Most academic studies put the real-world value at closer to 0.18%. The math simply doesn't add up. We said probably. Here's the exception. If you have $500,000 in a complex tax situation, tax loss harvesting might just barely be worth it. Or if you're the type of person who panic sells when the market drops, the app acts as behavioral insurance. If it stopped you from selling in March 2020, it paid for itself 10 times over. Or if you're starting out, depositing $50 a month, using roundups, building the habit of investing, the automation is worth more than the fee difference. Discipline at the start is more valuable than basis points. If that's you, keep the app. If it's not, listen closely. The alternative is simple. Open a direct account with Vanguard or Fidelity. Buy 3 low-cost funds: total US market, international, and bonds. Rebalance once a year. That strategy outperforms 80% of professionals and costs almost nothing. The AI in your app told you it was optimizing your wealth. Mathematically, it was optimizing its revenue. +4. The interesting question isn't whether your app is smart, it's who the genuinely smart AI in finance is actually working for. Next week on FinEye, we find out, and the answer will make you want to move your money. If this made you angry, subscribe. If it made you open your investing app just now, definitely subscribe. New video every week. We'll see you then.